a little bit of weakness, Shireen, filtering through, as you can see, to the local unit this morning. And, you know, we've got to ask you what your prospects for the local unit are looking like at this stage of the game, specifically on the back of those disappointing GDP numbers that filtered through yesterday.
Well, Alishia, we did change our forecast. We previously had a forecast of about 875 for year-end. We're now looking, or rather not year, in the first quarter of next year, we're now looking for further weakness in the local unit to about 9 rand, but we still view that the risks are fairly symmetrical on either side of that 850 to 9 rand level. So we are more or less in line with what the market is saying at this point, with a weakness going into next year.
Shireen, looking at that GDP number, let's unpack that a bit. It was expected. We said the previous time, the previous quarter, we knew it was going to be low. Was it lower than expected given that pessimism? And what are the knock-on effects going to be? Because we've talked a little bit earlier about the knock-on on retail, the knock-on on various other sectors of the economy.
Yes, indeed, David, it was a lot weaker than what we had expected and what the market had expected as well. We had expected a 1.7% quarter-on-quarter growth for the third quarter. The markets were expecting 1.5%. But what was the main standout was the reversal of the mining sector's growth. We saw a 30.9% growth in the second quarter of this year. That reversed to almost a 13% decline in the third quarter, which led to a substantial subtraction from GDP growth of about 0.6 percentage points. Now, if you look at what has actually happened in the third quarter, we saw the strikes in the mining sector start on about the 10th of August, and that spilled over into the final quarter of this year. We will probably see a significant knock-on effects, more so in the mining sector and the manufacturing sectors in the final quarter, and that could pose significant drag on our fourth quarter GDP numbers. The retail sector is also expected to have been impacted by the strike activity from the trucking industry. So we are also going to expect softer numbers coming through from the retail sector as we go into the new year. And that is going to impact on the festive spending that we have normally been accustomed to, fairly high levels. So we're going to see some significant drag coming through from both the manufacturing, the mining sectors and the retail sectors. And that is going to pressure our GDP forecast of 2.5% for this year. We do see that the risks lie increasingly to the downside of that number, and we could possibly be lowering it in due course. The
one that you haven't happened to mention, Shireen, is agriculture. Now, that was quite a good performer in this set of numbers, 7% growth there. But of course, we've had that Western Cape, the issues there with wages and violence and a crop that wasn't picked. How important is that going to be? Because on the one hand, there's export money that's not coming in, and presumably a retail impact in that region, but also more broadly, instability in the wage area in the agriculture sector generally.
Yes, that number did come in more positive than what we had expected. It came in at about 7.5% from 9.3% in the previous quarter. But just looking at the contribution of that total sector to GDP, it's not as significant. So it's not going to, even if we do see a fall-off in the agricultural sector, based on what you've just said with the wage disputes and the crops there in the Western Cape, we're not going to see a significant drag on the agricultural sector, which has been only contributing a very small percentage to total GDP of about 0.1, 0.2 percentage points over the past couple of quarters. So it's not going to be as significant an impact on GDP growth. But if you look at the retail sector, yes, indeed, that will have an impact on stocks in the stores and going forward into the festive season, where we do see a fairly high increases of food and beverages and vegetables as well coming through in terms of retail spending. So there is going to be some drag coming through from that side.
Has this data at all altered your view on interest rate direction moving forward? Because while this data puts the pressure on the Reserve Bank to reduce rates, we've got rising inflationary pressures, certainly leaving limited room for easing of policy moving forward, Shireen.
Yes, indeed, Alishia, that does leave limited room, but our base case has been for a while that we are expecting rate cuts to come through in the new year. We did, however, change our forecast from a January rate cut to possibly later on in the year, given the fact that inflation is still fairly high and could possibly creep up even further if once we start seeing the impact of the reweighting on the CPI basket coming through in the new year. So we do believe that there is significant, well, we're not really closing the door to further rate cuts and have penciled in a rate cut of 50 basis points in May next year.
Yeah, Shireen, just looking at the newspaper, the business report this morning, two of the issues we've talked about. COSATU warns of farm wage tumult, that just following up on what we said earlier. But the OECD, the Organisation for Economic Cooperation and Development, they're actually quite strong. They say there is room for a rate cut in South Africa by the Reserve Bank, and they say it should be used. It's a recommendation by them.
Yes, I did see that comment from the OECD, but we also have to bear in mind that the Reserve Bank is looking at a third component now, which is the current account, and they have mentioned in the past that the current account widening has placed significant pressure on them to not cut the interest rates. And if you recall, just looking at the past September numbers, August and September numbers for the trade balance, we saw quite a widening to 12.2 and 13.8 billion rand deficit. October's numbers are expected to come out on Friday, and we are also expecting another significant deficit. So that could possibly place further pressure on the current account deficit, and that could keep the Reserve Bank at bay at the next 2 or 3 meetings or so. But the Reserve Bank is cognizant of the fact that GDP growth is possibly going to be lower than what they had previously forecast for this year. And given that if they do use that as a primary reason for the rate cuts, then we could possibly see rate cuts coming in sooner.